Can you use a hard money loan for a down payment? Could you actually use one loan to fund another? Let's talk about whether you can use a hard money loan for a down payment. Here's the honest truth. Most lenders won't let you stack loans, but there are exceptions. In this video, I'm going to explain how you can cover a down payment creatively and when not to even try. In this video, you're going to get clarity on how down payments work in the world of hard money and creative ways that investors come up with the funds even if you haven't done a deal before. So you won't get a hard money loan to cover a down payment on a traditional loan. Banks just simply won't allow that. But let's discuss how hard money loans actually work and how you can actually get one of them for your flip or for your business without coming up with a down payment on your own. So why do hard money lenders want to see a down payment for your loan? Well, the bottom line is they want to see some skin in the game. They know if you have skin in the game, you're a lot less apt to walk away from the deal because for them, it might be a small amount of money, $5,000, $10,000, but for you, it might be your life savings. So you don't want to walk away from that kind of money. So they want to know you have some skin in the game. But the real question is, where did you get the money from? You see, a hard money lender, or any lender for that matter, is going to want to, what they call, source the money. Where did your down payment money come from? Some lenders just say it has to be in your account for 30 days. We don't care what account, if you have multiple businesses running or whatever, as long as the account is the account that you have, if you can prove to me that that $5,000, $10,000, or $30,000, whatever the number is, if you can prove to me it's been in your account for 30 days, we consider that seasoned and it's your money. Some lenders might want to see it in the bank for longer. It's important that you understand your lender and the requirements for the down payment. And I'd be right up front and ask them. So when it comes to the down payment, where do you have to see the money from? Where do you want to see it? Do you want to see it in my checking account, in my savings account? Where do you have to have it from? Because if you know how long you have to have it in your possession, you can position this accordingly. Because what I'm going to encourage you to do is if you want to use a down payment for a hard money loan and they require seasoning, you may have to borrow that money from somebody else a month or two beforehand and get it seasoned in your account. Does that make sense? So there's going to be some risk and some relationship building you're going to have to do to get it done, but it certainly can be done and is done on a regular basis. What you'll find is that some lenders care. Some lenders have an underwriting requirement that you have to have that money yourself. And some don't care. They say, I don't care where you get the money from because I'm in first position. Meaning if you default in the loan, they are the first person to get paid if a foreclosure has to happen. So they don't care who's after that. They just know that they get paid first. So they may not care. So it's just important to understand who you're dealing with and what their concerns are when it comes to down payment money. Typical hard money lenders will lend you anywhere from 70 to 80, maybe even 90% of the purchase price of the property. It just depends on the lender. And usually anywhere from 80 to 100% of the renovation cost. Now those renovations are paid to you in draws, meaning you have to have the cash up front to be able to pay contractors and get the work done, then you'll get reimbursed from the hard money lender. You could have the contractor and the material provider provide you with some credit terms so that you can actually get the work done, then get the money from the lender, and then pay those people. There's a lot of clever ways to do 100% financing. You just have to really be thinking outside the box all the time. I tell you this because if you are Googling how to not put a down payment down, my guess is that cash is tight for you right now. And that's okay. One good flip will put cash in a good position in your life. So how do you get that done? That's what I'm trying to help you do in this video. Keep in mind that you're going to have to pay the lender, a hard money lender, interest-only payments, which can be significant. If you're borrowing a couple $100,000, it might be $2,000 a month you're paying in interest-only loans. So you're going to have the cash flow to be able to make that payment long before you actually sell the property and get your profit back to pay off the principal. For those expenses, you can't usually use borrowed funds. I mean, you can't go to the hard money lender and say, can I borrow money so I can pay you for the next 6 months? That's usually not how it works. But what I'm going to encourage you to do is find a gap lender. Gap funding, the gap is you borrowed, let's say 80% of the purchase price and 100% of the renovation cost from a hard money lender. You're left with 20% of the purchase price and you need to have cash flow to be able to cash flow your renovations and get the work done, then get the money that comes in from the hard money lender to reimburse you. But it still requires cash to make this business vehicle work if you're using hard money. So I'm going to suggest that you use gap funding, meaning that there's a gap that you're lacking. If you don't have that money, use gap funding. That doesn't have to be another person, it could be you. You might have access to capital you're not thinking about. Do you have a whole life policy with a cash value that you could borrow against? That's one option. Do you have a retirement account or an old IRA or an IRA or 401k that you can borrow against? Well, that might be something you should consider. Do you have another property you can borrow against? Do you have a home equity line of credit on your current residence you can borrow against? Do you have credit cards that have cash options that you could actually borrow on your own credit cards? Do you have good credit where you can go out and get 0% funding on credit cards and be able to use that money to be able to cover the gap? If it's not that, I'm going to suggest that you raise money with private lenders. Private lenders are just average, everyday folks that want to loan money on real estate transactions because they have money sitting in an account. You might say, I don't know anybody who has money. I disagree with you. I guarantee if you don't know somebody, you know somebody who knows somebody. And I'm never going to teach you to go ask your family and friends for money because that sucks. What I did, I came up with a system that I teach. You can actually find it here on our channel. And I teach people how to go out and put together a packet to say, I'm looking for private money. As a matter of fact, I have found 80% of the money for my flip. I need about 20% more on this deal. And I want to know if you know anybody. Matter of fact, I'll pay you a referral fee if you let me know of somebody. And what you're doing is you're indirectly asking people to become a private lender. Most people that are interested will say to you, well, what about me? Tell me more. And because you're not asking them directly, they don't feel like they have to push back on you, right? So just a clever way to go out there and ask everyday people to loan you, let's say $20, $30, $40, $50,000 that you might pay them 10, 12% on so that now they can make money, you can get your deal done, and it's 100% funding. And when you have cash, all the pressure is removed. Well, I shouldn't say all. A lot of the pressure is removed to get that flip done. You don't have to worry about your next monthly payment because you have the cash in the bank from your private money lenders. And then when you sell the property, then you pay off. The first person you pay off is the hard money lender. The second person you pay off is the gap funding person. Now you're gonna have to pay a little bit in interest there, but if you paid $5,000 more in interest, but you're able to put a $50,000 profit in your pocket and remove the stress, isn't that a good deal? There's one final way that I'll talk to you about, and that's what's called the seller carryback. There might be an option that a lender might allow when the seller actually takes a loan on the property for the amount that you still owe. For instance, let's say, for argument's sake, the property was $100,000 and the hard money lender gave you $80,000. You'd still owe the seller $20,000. Maybe they say, you know what, you can pay me that $20,000 after you flip the house in 6 months or a year. I just want to get 10% of my money, or 10 or 5%, or maybe no percent. You can negotiate that out. Some lenders will allow a seller carryback, some will not. It's always worth asking. You know, hard money only works when the deal is solid, and you have to know how to buy the deal correctly. Because of that, I want you to watch my training where I teach you how to define the perfect buy box for you. And the buy box is the property that makes you the most amount of money in the least amount of time with the least amount of risk. So the link is right here in the description below. Click on this and watch the video on how to define your buy box to become a very successful real estate investor and maximize your profit and minimize your risk.